So with the stock market crashing by so much right now, I figured this would be a good time to go over some lessons that I think can be learned from all of this so that we can become better and stronger long-term investors for it, and at least some good can come out of all of this chaos that's going on right now. So I came up with 5 lessons that I want to go over with you guys, and I really hope that you enjoy the video. But with all that said, let's go ahead and get started. Hey, what's up everyone? My name is Ale. Welcome back to My World of Stocks. Okay, now what better way to kick things off than to start with a mistake that I've personally made and a lesson that I've had to learn the hard way, and that's how incredibly vulnerable we are to these type of global issues. I can't directly mention it here on YouTube, but it's that thing that is kind of spreading around the world that is also causing the stock market to crash. And that's been very surprising to me. I've personally never seen this kind of reaction or panic to something like this. And I'm not saying that it's not serious, I'm not saying that the reaction to it isn't justified, but I can honestly say that I didn't think or I didn't expect it to get this serious. And I also didn't think that we would essentially shut down the global economy to try to deal with it. I mean, who would have thought that destroying the global economy was so easy? And of course, the human impact on its own is incredibly tragic, but in the stock market world, the snowball effect of all this is that it also destroys the economy, which then destroys the stock market, which then destroys our portfolios. So it's a really big deal. And I'm just being honest, I just never thought that this particular event here that we're going through, I never thought it was going to cause so much destruction. So it's a lesson that I had to learn the hard way. So in total, I really think that there's two kind of sub lessons to be learned here. And one is how vulnerable the world and humans are to this type of global issue. And then number two is how delicate and also incredibly vulnerable the economy is to these type of issues. In fact, a number of analysts are now predicting that we could have a worse economic impact than WW2 and are also going as far as to say that it could be even worse than the Great Depression of 1929. I don't know how much I agree with these projections myself, but I am definitely worried about so many companies being forcefully shut down and people losing their jobs and what kind of damage that can cause to the economy. In fact, Goldman Sachs is projecting a record-breaking spike in jobless claims this week. Now, we have to keep this in context because this includes people being forced to stay home for a while. It doesn't reflect the entire recessionary period. And if this is indeed a temporary issue that will go away in the second half of the year, like many are predicting, including myself, then a lot of people should be returning to work and we could potentially see a sharp recovery towards the end of the year. But it just goes to show how incredibly vulnerable the economy is to these type of issues. And I can honestly say that I was not expecting this. I can be very honest about it. It's a lesson that I had to learn the hard way. And I was very overly confident and I was a bit overly cocky, I guess you could say, that I didn't think things would get this bad. And so I think as investors, we need to go forward realizing that the way that the world reacts to these type of issues can have such a devastating impact on the economy, and we need to be aware of that as investors going forward. So we probably should be treating these issues a lot more serious than maybe some people have, and including myself. Okay, so lesson number one was how incredibly vulnerable we are to these type of issues and how our reactions to them can have such a devastating impact on the economy and on the stock market. So moving on to lesson number two, that's going to be how incredibly vulnerable travel stocks in particular are to these type of issues. And we've seen that with industries like the airline and the cruise line industries getting absolutely destroyed. In fact, in just the past 1 month alone, United Airlines stock fell by almost 70%, American Airlines fell by 63%, and Delta Airlines also fell by around 63%. Meanwhile, cruise liners like Carnival fell by over 72%, while Royal Caribbean fell by close to 80%, again, in just the past 1 month alone. That's pretty crazy because, these are normally very profitable companies. So just imagine losing close to 80% of your value in just a 1 month span. I mean, this is a stock here that just earlier in the past year was trading at over $135 a share, and now it's only worth around $23. And of course, other stocks that have heavy exposure to group gatherings have also been crashing as well, like Six Flags, for example, falling by close to 70%, and then to a lesser extent, Disney falling by about 40%, but you get the idea. So it's just really surprising to me how some of these great companies can be so easily destroyed by an unexpected event like this. And I really hope that the entire world learned a lesson here, and that's that we need to be better prepared for these type of unexpected events. Because in my opinion, that global issue, that thing that is spreading around the world, that thing could have we could have actually gotten a much worse version of that thing, and in the future we may get much worse versions. But look at how incredibly unprepared we were just to this one, and look at how much destruction it's done, not just to people, but also to the economy and to small and large companies that also employ a lot of people. So we need to have plans in place for dealing with this. We can't go into the future being so incredibly unprepared and having such a chaotic response to these type of issues. And I'm not saying that this thing was purposely sent out there, but I think countries and groups can absolutely do that in the future, and they'll probably try to send things like that out there. We need to be much better prepared. This was a real wake-up call, I feel, for me and for the rest of the world, hopefully, that we need to be better prepared for these type of things. Now, as far as us investors go, lesson number two, again, it's that these type of stocks can be very heavily exposed to these type of issues, and it's something to be aware of because they can easily get destroyed if we're not better prepared for them going forward. And by the way, I was previously nibbling a little bit of some of these stocks like Disney, Delta, and Carnival, but since then I've made several videos where I've talked about the fact that I was shifting my focus over to much safer stocks that are being dragged down by the broader market. And I'm also focusing more on some dividend stocks because I think a lot of them, their dividend yields are reaching some very attractive levels as the prices drop. So my focus has shifted a little bit, but I do still think that a lot of these stocks will eventually recover over the long term, and especially something like Disney that in my opinion is much more than just a theme park operator. So Disney is actually a very large position in my portfolio, and yeah, I do plan on holding that one because again, I do think that they will recover over the long term, but we'll see how this kind of plays out. I just think as investors we need to be aware of these issues. And by the way, I will make an updated video on which stocks I'm buying throughout this crash. But speaking about falling stock prices, that brings me to lesson number three, and that's that something that has really helped me a lot throughout this entire market crash has been buying in small amounts and gradually over time. If I would have gone too heavy into some stocks, and admittedly I did go pretty heavy into Visa, but if I would have gone heavy into all the stocks that I've been kind of nibbling at here throughout this crash, I would have run out of funds pretty quickly, and that would have made it a lot harder for me to buy new stocks that come up on my radar, but also to be able to lower my cost basis on any stocks that I already own or that I'm buying. And so this is really a fundamental, very important and very crucial part of my investing strategy, which is to buy stocks when they're going down. Now, I do obviously also buy stocks when they're going up, but I'm just saying that I do the majority of my buying when stocks are going down because that's when they're the most attractive to me. That's when I feel that I'm getting the most value back for the price that I pay. So what I like to do is I like to start off very slowly. If a stock is going down, I'll start off very slowly. I may enter that stock with a very small amount and then just kind of gradually add to it as it continues to fall. And as the price continues to fall and the deal gets better and better and better and I like it more and more, then I'll increase my buying. So I'll buy more aggressively the further down that it goes. And by the way, if that's hard for you to do because of the share price being too high, like something like Amazon or Google that have really high share prices, and so it's hard to buy, multiple shares as they're going down or whatever the case is, you can always use fractional shares. So for example, I've been using M1 Finance more than my E-Trade and my Robinhood accounts throughout this entire crash because with M1 Finance, I can put in a specific amount of money that I want to buy in a stock, and it doesn't matter what share price the stock is trading at, how high it is or whatever. I can put in a specific amount of money, and that makes it a lot easier for me to buy in smaller amounts or whatever kind of amount I want to do, however I want to average it out, and then I can just kind of keep buying on the way down. And then if I want to increase that, I can increase it and all that kind of stuff. And by the way, before anybody goes off on me in the comment section, I am not sponsored by M1 Finance. I'm not even a really big fan of M1 Finance. I think it's a pretty clunky kind of platform, and I don't like how long it takes to fulfill an order and things like that. So when Robinhood gets fractional shares or when I get approved for it, I think I'm still behind like 2 million people. But whenever I get approved for fractional shares on Robinhood, I'll probably just be doing it on there. But in the meantime, M1 Finance can be a great option for anybody who's trying to follow that kind of strategy of buying in small amounts as the stocks are going down. So that's really one thing that has helped me throughout this entire crash and allowed me to buy slowly and gradually over time, and then just kind of increase my buying the further that stocks fall. However, in order to do that, I would need to have cash available to begin with. So that brings me to lesson number four, and that is that you need to have cash on the sidelines to be able to use. And I can't tell you how many times I've made videos saying that around 30 to 40% of my portfolio is actually in cash, and I've been heavily criticized for it because people would tell me, how could you have so much cash on the sidelines? And they'd be very critical of that. But what they don't understand is that me building up a cash position in my portfolio doesn't mean that I have to stop buying stocks. In fact, I continue to buy stocks, but the way I do it is I take my monthly budget, okay? I take my monthly income and I take the portion of that income that I use to invest in stocks. So whatever my budget is for stocks, and if I don't see a lot of good deals out in the market at that time, then I'll just put more of that budget into the cash position and then I'll invest whatever is left over. So, for example, if I'm not seeing a lot of good deals out there, I may put 80% of my monthly budget into the cash portion and then I'll invest the other 20%. So I can continue buying stocks and not worry about timing the market, but at the same time, I can build up my cash position if I feel like we're probably overdue for like a healthy dip or a correction, which is important for being ready for when that actually happens. And a great example of that was that big correction that we had at the end of 2018, where stock prices were getting extremely attractive in many different cases. And luckily, I had the funds to take advantage of it, and I bought some great stocks at some great prices. And look, it doesn't even have to be a full on market dip, correction, or even crash. Sometimes an individual stock might be falling just because they have company specific issues, and I want to have the funds available to take advantage of those falling prices whenever it does happen if I like the company. And so a couple of recent examples of that would be what I did with some stocks like AT&T and also AbbVie. With AT&T, the stock fell all the way down to below $30 a share, while the dividend yield climbed above 7%, mostly because the company is going through a transitional phase. And by having cash on the sidelines, I was able to buy up a lot of the stock around those prices, and I've been collecting a very large dividend every quarter from them ever since. And by the way, yes, I am also adding to my AT&T position currently because they are, again at those lower prices. But a similar thing also happened with AbbVie when they fell to the low 60s and the dividend yield was also over 7%. And again, I had the funds to build up a very high yielding position that I've been very happy with. And so again, when I don't see a lot of good deals out there, more of my investing budget goes to the cash position. When I see good deals out there, I may use all of my budget for stocks. And when there are great deals out there, when there's like a stock market crash, kind of like what we're going through right now, I may be using all of that budget, and I may even tap into my cash reserves if I need additional funds to be able to take advantage of some great deals out there in the market. So anyway, you can be critical of that strategy. You don't have to agree with it. You can leave your thoughts down below, but it's a strategy that has worked for me, and it's one that I've been happy with as a long-term investor. So I'll continue to use that type of strategy. And by the way, when I say cash, I don't mean like cash under my mattress. What I mean is like cash, ideally in a bank account, hopefully yielding you some kind of interest on that money too. But it does need to be fairly liquid. For me personally, I like to have it readily available for when I do need it, and I do actually keep a lot of it just straight up in my investing account, so that I don't have to wait for it to settle, for the money to settle. I just have it in there and I have it ready to go. And some investing brokers actually give you some interest for having it in there as well. So you can figure out that on your own. Maybe we could make a separate video on that, but I just wanted to give you kind of an idea of how I do it. Okay, now I know most of you are thinking, how can I put all of my money into my investing stock portfolio? What about emergencies or savings? And how does all of that work? Well, that brings me to my final lesson. That's going to be lesson number 5, which is that obviously I do not put all of my money into the stock market. And this is something that is pretty hard for me to get through to certain people, which is that you should not be investing your life savings into the stock market. And you'd be surprised at some of the comments I get from people saying, oh, my life savings are in this single stock and I think it's going to skyrocket. You should not be doing that. And if you want my full honest opinion on this, I really think that most people should only be investing with money that they absolutely do not need. And in order to do that, you do need to have some savings in case you run into some difficult financial times where you need some cash. and you might be forced to sell your stocks during a market crash. If we're going through some kind of recession or something, you end up selling your stocks at a huge loss and you just end up losing a bunch of money. So you do need to have some savings for those difficult times. And something that I always get asked about is, well, how can you be buying stocks when they're going down if you might be going through some very difficult financial times? Maybe you're going through a recession, maybe you lost your job, maybe you have no income. How can you be buying stocks when they're falling like that during a market crash or similar situations? And my response is, look, you can't predict everything in life. You might be going through a very horrible time period where you absolutely just cannot buy any stocks at that time, and it is what it is. But most of the time, the economy is usually doing pretty well, most of the time. And when it is, I would assume that you have a pretty reliable job and you have a good source of income. If you don't, you shouldn't be investing in the stock market to begin with. But assuming that most of the time you do have a steady job, most of the time you are generating some kind of income, you should be saving. You should be saving some of that money. You should be putting some of it aside. And I generally like to think of having around 3 to 6 months of minimum income saved up. And what I mean by that is enough money to pay your rent, pay your bills, and buy some food. Having around 3 to 6 months can be a big deal because that can give you, a good amount of time to look for a job or something like that. And that would help you to not have to sell your stocks for a loss and maybe even continue investing if you also have a portion of your portfolio in cash, which is what I do. So that's how I think you kind of deal with those type of situations, having savings, and then apart from that, having your portfolio, and in your portfolio, having a portion of that being cash. But having those savings and having that cash in your portfolio, that's generally how you can take advantage of these type of like market crashes and things like that. So that's the best response I can give to that. I don't really know what else I can say to that. And I will just add one more thing, because people say, well, it's too hard to save, or I don't have enough income to save. Again, if you don't have enough money to save, you probably don't have enough money to be investing in stocks. So that's number one. Number two, most people spend a ton of money on ridiculous things that they don't need. And for me personally, look, I know you may not relate to this at all, but for me personally, I actually really enjoy investing in stocks. So I find happiness within it. I enjoy investing in stocks and researching stocks and investing in them. So instead of going out to bars all the time, or clubs or casinos, or even traveling around the world, which is something that a lot of people waste a huge amount of money on, and I'm not saying it's bad. Look, if that's what makes you happy, do whatever makes you happy. But for me, I actually have a better time saving my money and investing in stocks. I actually do find a lot of joy in that. But the point is that there's always ways that you can cut your spending. There's usually things that you're just blowing money on. And so you need to figure out what those things are, cut your spending, and be able to save more. And that will in turn allow you to be able to invest more. And again, if you don't have enough money, if you don't have enough income to save, you probably don't have enough income to invest in the stock market. And that's what it ultimately comes down to. Okay, so I think that just about does it for the video. I hope I didn't offend anybody. I didn't mean anything to be like offensive. I was definitely trying to just like help as much as I can. But okay, so just to kind of sum everything up. So lesson number one, that was the impact that all of this can have on the entire world, and that we need to be better prepared for it. Lesson number two, the kind of impact this can have on specific stocks like travel stocks and things like that. Lesson number three, buying in small amounts. This is maybe more specific to me for my strategy, but if you're going to be buying through a market crash, then you should be buying in small amounts so that you don't deplete your funds. Lesson number four was having cash on the sidelines. And what I mean by that is in your portfolio, having a portion of that in cash so you can take advantage of these type of situations. And then finally, lesson number five is having savings outside of that. So if you do run into some difficult economic times, you do lose your job, anything like that, you're not forced to sell out of your stocks at a huge loss. And you can hopefully get through this time period and become a better investor and just be stronger as you make your way through it. Okay, so that does it for today's video. I hope you guys enjoyed it. Let me know how you feel about all of these lessons. Do you agree or disagree with any of them? And are there any that you would add to the list? Let me know down below. I'd love to read some of those comments and hopefully respond to some of them as well. If you enjoyed the video, please consider hitting the like button. It really helps the channel survive and grow, and it really means a lot to me. But with that said, I'll catch you guys in the next one. Take care. Stay safe out there. Bye-bye.